Let's get going. Thank you everyone for dialing in and welcome to the Altus overview of the NCREIF ODCE Index. Thanks everyone for dialing in. I think we've got over 1,600 people registered for today's call, which is great. So thanks so much everyone for their interest in the analysis. I'm Phil Tiley, head up our analytics part of the business, and with Robbie Tangent, who hosts up the global side of the Altus advisory business. We'll be taking you through the latest numbers on the ODCE. So these are based off 25 ODCE funds, so the entirety of the ODCE data set, which we then match up with our own valuation data set to provide added intel into the analysis. The webinar is part kind of insight for our wider network of clients, but it's partly a precursor to the one-to-one client conversations that are NCREIF members, where we replicate this analysis, comparative analysis, onto a one-to-one basis. We look forward to having those conversations in the weeks ahead. Before we pass over to you, Robbie, just a quick word of thanks. It's a collective effort, this. So thank you, everybody at Altus, for helping pull this data together. And obviously, thanks especially to our clients for giving us privileged access to their data. Maybe, Robbie, we should start where we finished off last quarter, where the polling questions, if I can move my slides on, we finished off on this polling question, didn't we?
Thanks, Phil. Yes, and before we start, just a reminder, if you have a question, please put them in the question box in the chat, right? And we will try to address them as much as we can. If you're not be able to address them during this webinar, we will address them during a one-on-one with our client, or some of our team member will email the responses. On the polling question, we do that every quarter, right? So I think beginning on last quarter, we asked what is the expected unleveraged property return to be in fourth quarter. So yeah, majority do answer being -2 and +1. I think they're not fully correct. I think the C is the correct one, Phil.
Yeah, that's correct. The result does finish in that C bracket where 40% of respondents responded to the survey. Let's put those numbers straight on the screen there. The market did experience a comparatively large setback at the end of the year, closing off the year with a -3.4% total return. Just to clarify what we're reporting on here, that's income and appreciation, and that's the kind of pure real estate side of ODCE. So there's no cash, there's no fees, there's no leverage in that number. It's a pure real estate piece. Throughout the course of 2023, the market had been in the first phase of a period of contraction, but the level of decline has been tapering off, just from that grading to the line. But that trend, though, was then reversed in the final 3 months of the year. Q4 marks that's the 5th consecutive quarter now of negative rates of return. Compare that with the onset of the pandemic, when returns just went negative for 1 quarter, before then embarking on that kind of unprecedented growth run when returns reached up to near record levels in excess of 6%. And that latest return, in terms of setback, is pretty much similar to what we saw at the initial point of the correction at the back end of 2022. So the market, and indeed the overall kind of business environment, may be starting to receive a few positive signals. Now, coming out of the Fed, talk of expected rate cuts expected through the course of this year as inflationary pressures ease. But for now, based on these numbers, commercial real estate is still very much on a downward trajectory, and that's with an annual return of -8.7% for the year. Let's go straight into unpacking those numbers and break them down into their income and appreciation levels. So leading up to the pandemic, real estate was providing investors with a pretty consistent income return, coupled with a portion of appreciation. That performance profile of the market's pretty much been turned on its head, one way than the other, during the course of the last 4 years. From an appreciation standpoint, so just focusing on the red bars there, you can break the kind of recent period really into 3 distinct kind of slots. You have the write down at the onset of the pandemic, which on reflection was relatively minor in the wider scheme of things. Values then down by 2.5%, as indicated there. And the market went on to 7 consecutive periods of growth, during which just shy of 23% was value added to the value of real estate. We then enter the current period of correction, during which values have so far dropped by 17.3% over the course of the last 6 quarters. The level of decline had been tapering off, but that trend very much changed course in the final 3 months of the year. Values down by 4.4% in the December quarter. Then what we're able to provide within ODCEs is to give added insight into that appreciation return. By drawing on our valuation data set, we can determine how much that movement in the value is a product of first the kind of the economic fundamentals versus what might be termed the investor sentiment, or possibly more relevant now, the kind of capital markets side. So we transpose the red bar here onto the red line. We bifurcate that red line into what's termed the yield versus the cash flow effect. The yield effect is how much of movement in value was dictated by the change in actual valuation yields. That's movements in discount rates and exit caps. The cash flow, the blue bar, is the impact on values from the change in those forward projected cash flows and effectively priced by those yields. So 2023, for often, most people kind of characterize that as a year when real estate continued to kind of reprice in response to that kind of higher cost of debt against a somewhat kind of muted economic backdrop. And that's pretty much what we're seeing playing out in these yield and cash flow effects. It's the yield increase, now the yellow bars, that's been the major protagonist, continuing to pull back on values as the market adjusts to the increased cost of capital environment, which has put a squeeze on obviously the availability of debt. Robbie, the 10-year Treasury actually came down in the final 3 months of the year, but also there's a lot of talk about price discovery. Maybe there's also a sense kind of heading into that last course of the year that real estate needed to catch up to where rates had gone or have been. So maybe your thoughts just on that kind of pricing adjustment we saw notably in the final 3 months of the year there.
Sure. It's definitely an interesting discussion during period, right? So it's a very murky quarter to begin with. We get the geopolitical situation, you get the Treasury, you get the Fed. The 10-year Treasury went on roller coaster ride, right? So it started with 4.6 in the beginning of the quarter, shoot up to 5, and then finally settling at 3.9, right? But we all know, right? So while there's some correlation cap rate to Treasury, it doesn't go fully elastic with the Treasury movement, right? So most investors are looking at more, what is the long-term 10-year borrowing cost look like? Is it higher or is it lower? Despite the Federal Reserve pausing the interest rate hike, a majority investors we talk to still projecting kind of the 10-year around 4 to 5%. Right? That's what we're seeing in the investor underwriting, right? So basically higher implied yield to transact. Volume definitely down, right? So the transaction volume is down, but it's still more than 300 billion transaction in 2023, right? So I always said that the overall kind of the yield movement effect is more reflective of pricing discovery, which is higher yield to transact bill.
Sure. Thanks for that insight there, Robbie. And then for me, it's almost as important to take a note of what's playing out on the cash flow side of the equation. When the economy looks to be potentially heading for a soft landing, having avoided the recession that a lot of the leading economists were anticipated as we headed into last year. But as a result, therefore cash flows have just about held their ground through the course of the year, but with no real upside. So no counterbalance to the market, subsequently feeling the full effect of those yield increases. And then what we saw play out in that final bar in Q4 was the projection of those cash flow levels just started to being scaled back a fraction, which kind of goes to serve as a reminder just how precariously poised past market are at the moment. Can you still hear me?
Correct. I can hear, we can hear you.
Sorry, so my earphones just went there. And obviously what we're capturing here in that decline in the cash flow is some increase in supply, some cooling in demand levels, all of which is kind of taking place at a time of increase in operating expenses. So maybe, Robbie, your thoughts on that, just so slither of downside there on the cash flow side of the equation.
Sure. And just a reminder, the blue bar represent relatively cash flow changes relative to forward-looking kind of appraisal forecast on each asset. Right? In this case, negative cash flow bar does not mean a declining NOI. Rather mean it's lower projection on a 10-year forecast compared to previous quarter. Do I look at it? It's because, as you indicated, Bill, the expected slowdown economies, appraisal are now incorporating slower growth. And I'll talk about it later on as well, the higher expenses, right? So we all talk about inflation, higher expenses, higher. So that's a few primary driver for the negative cash flow effect this quarter.
Sure. Okay. And so we'll get into the detail of the sectors. So let's go straight there, open up those return series on the sectors. Up top there, you've got the confirmation of the slowdown in the return down to minus 3.4%. The operating asset return at minus 3.3 is a shade better off. So that's the inclusion of developments, bringing that down. That's pretty consistent with periods of kind of contracting returns. You would see developments take things down a little shade a little bit further. And then the sector trends, we finished the year with negative returns across the board and a dialing back in performance in each of the main property types. That said, there's still kind of a mix set of results, and we've color coded those results, reds and greens, north or south of that operating asset overall return. So start off there with offices, no surprise there. They're the outlier. They continue to be cast further adrift, return of minus 6.1% for the quarter. Also at the lower end of the performance order now is the apartment sector coming in below the Odyssey sector, maybe starting to feel the pinch from near-term increase in supply, some affordability issues creeping in there. Industrial and other is the largest part of that is self-storage. Now, they've not avoided the performance setback in Q4, but they both in green held out comparatively well in the wider scheme of things with similar rates of return. And then here you have the retails continuing now to prove a more resilient path to market, but returns there also dropping back, turning negative in the final 3 months of the year. So pretty much everything finishing the year trending in the wrong direction. But Robbie, any immediate thoughts on how those kind of return levels are actually playing out there?
Sure. It's one thing I realized, I took a break for 1 quarter and returned trending downwards.
Okay.
Yeah, but overall, I think that's one thing to note as well. The dispersion size can be quite interesting in there, right? With office being the worst performing sector, trending downward further, right? But retail's holding better. So we see that dispersion kind of basically more elevated again this quarter compared to previous quarter, right? And I know many are asking as well, what's the cost of dispersion on many various funds? So one of the factors is this, right? So if some fund owning more allocation to office, they're going to be lower, right? So if some fund having more retail or industrial, they're holding up the better, right? So I think that's one thing that can be got that stood up for me in this chart.
Sure. And I think you're right there. I think the allocation actually comes more into play when you look back over the full of the last year, and maybe even more so over the 3 to 4 years. Q4, I think one point to note is all sectors are contributing to the lower of the overall as you return. I think we also got to remind ourselves that while it's notably cast adrift, offices are now just 20% of the overall. See, I think we've used this chart in the past. This quantifies how much each of the sectors contribute to that dotted line, the Odyssey rate of return. So here we're factoring the returns on the prior slide with the weight. So the downside, which in prior quarters became increasingly focused on that green, the offices, is now more dispersed across the sectors, similar to what played out actually at the initial point of correction at the back end of 2022. And for me, the market was a lot more lopsided during this upswing and that growth period when you had the industrials and the multifamily, which were running so far in advance to the other sectors. That's when I feel that the allocation kind of plays really came into the mix. But as you mentioned, Robbie, a fund with a disproportionately high weighting in offices at the moment is going to be more challenged, and high and low office content does differentiate some of the outliers. But I think the disparities across the sectors really becomes more of a factor when you look back over the last 3 to 4 years. So on that point, the next slide focuses just on value movements. First, in terms of green, looking at things from peak to trough, that's there, that bar there. That's a 17.3% decline overall, peak to trough, that's so far, with about a third of the value taken off the office market in the current period of correction so far. Apartment values are down 17%, actually 5%, almost a third of that came through in the closing 3 months of last year. Industrial other down around 10 to 11%, retail shade better off, values down by 9%. But those green bars are only part of the narrative. You track back movements to the onset of COVID. That's what we're showing in the purple bars. So that final bar on the right-hand side, just into the negative, indicates that values are now 1% below where they were at the start of COVID. So all that upside in that growth period has been cancelled out in the current period of correction. Although within that, industrial values are still significantly up there, 50% elevated, over 50% elevated. Other, mainly self-storage, over 20% up. Retails and offices are both net down. Offices, notably, and apartment values are pretty much back to where they were. So this is where you see the dispersion, to your point, I guess, Robbie. 80 percentage points opening up between the top and the bottom end sectors. So allocation plays really would have made a difference when you cast things back over the last 3 to 4 years. That's the kind of detail we get into when we talk to our clients on a one-to-one basis. Let's take it one stage further, unpack those sector appreciation levels here in the red lines into those cash flow and pricing metrics. First off, let's start on the top right. So industrials, notably elevated, and that's thanks to that kind of phenomenal set of gains during this growth period with kind of that's a period of kind of rampant rental escalation, and that's being picked up in the blue bars. The cash flow effect. The apartments, it's almost a kind of period of two halves here, mix of positive investor sentiment and strengthening fundamentals on the way up, which have now pretty much all been cancelled out as a direct result of that step change in the interest rate environment and the adjustment out of those yields. Office and retails, more downside than upside. Offices, notably, continuing that in that respect. If you take a look to the right-hand side of each of these charts, that more pronounced adjustment on pricing that we saw overall, you can see it's pretty much evident across all sectors. Industrials still have a little bit of a protective cash flow buffer, certainly not sufficient to combat that movement out in yields, and actually those cash flow gains have been easing off. Move down towards the retails, and that sector's been right-sizing, rebalancing from a position of significant oversupply. So here, cash flows are thankfully now back into the ascendancy, but only by a small margin. Apartments and offices, it's really the reverse. Those blue bars have been dropping below the line. For apartments, the cash flow decline looks to be relatively minor in the last quarter. There will be aspects of oversupply in there, dampening the dynamic of the sector, the time of escalating operating expenses, and that as a collective is starting to put downward pressure on those cash flows. It looks small, but it's actually pretty widespread across the geographies, and we'll come on to that in a second. And then you have the office sector, totally different set of circumstances here, going through obviously a significant structural change. Everybody's fairly familiar with that. But I think what's important to note from those bars now, 5 successive quarters of cash flow contraction, and the downside in the office sector is almost as much about cash flow contraction as it is about the kind of the pure pricing adjustments. Next slide just takes the other sector and separated that below that. We've taken out the storage component. Storage is the majority, the larger part of other. And you can see here that rate rises again were the major protagonists, pulling down on values. But in the storage part, the cash flow element is also just trending south. So some of the demand drivers begin to be dialed back there as well. Focusing now specifically on the most recent quarter, that's your appreciation broken down into the yield and the cash flow, or whatever way you look at it for the last quarter. It's those orange bars, the yields, so they're doing most of the damage. But cash flows are playing into the hierarchy, holding things down for apartments, offices, providing an element of stability on the cash flow side on the retails and the industrials, but it's the yields that have the biggest bearing. So maybe let's start to dig into those first. And it's in its simplest form, I've just charted here, you're going in cap rates and those kind of cap rates calculated on a year 1 to 5 basis. So capturing some of that kind of market rent upside. Points to note, with the exception of the industrials here on the left-hand side, those cap rates are understandably all ahead of where they were pre-pandemic. Industrials different with that contract to market rent spread, and we've got some analysis on that later on. And there's been no let up in those adjustments in the final 3 months of the year. A couple of key movements to pick up on the charts. First, the kind of wedge that started to open up between the industrials and everything else at the back end of 2020, most specifically the trade-off there with the retail sector and that kind of structural shift clearly being exacerbated during the period of the pandemic. And then maybe more recently, more topical, is that movement over between the offices and the retail. So evidence how the challenges now impacting the office sector are clearly surpassing those of the retails. And then you see that more visibly on a 1 to 5 year basis. If you look at the yields then that are being applied in the valuation, so that's your discount rates and your exit caps on the right-hand side, and how much they impact on value quantified under that yield effect. This shows for Q3 to Q4, how that really stepped up in order of magnitude in the final 3 months of the year. The darker shade bars are Q4, the lighter shade bars are the Q3. Put in an additional bar here, the gray, which is how much those changes have occurred since the onset of the pandemic. So there's your current marks for your exit yields, your discount rates. On a total basis, those discount rates are now 110 basis points ahead of where they were. Office discount rates are 170 basis points up on 4 years ago. Exit caps up 70. Office exit caps up over 110 basis points. So Robbie, maybe get your thoughts on this price slide about how things have moved both in the near term, but also where things are priced now relative to where they were before the pandemic, when it was obviously a totally different interest rate environment.
Yeah, I think that there you look at the 10-year did move down in fourth quarter, right? But on the overall trend, it still move up, right? So if you look at the treasury was 1.9% at the end of 2019, it's kind of 3.9% end of fourth quarter, right? And again, many also still forecasting after index between 4 to 5% long term on a 10-year basis, which is what included in the many of the underwriting. But if you see the transaction cap rate, the cap rate continue to move up. And that's what being reflected in fourth quarter. And during 2023, the increase in the discount rate, exit cap rate is more reflecting of the increased yield to purchase the asset. So,
Okay, good. Thank you for that extra detail there, Robbie. Let's go to the other side then, the cash flow side of the equation, which is, say, less impactful overall, but had started to taper off with variances across the sector. Here, for the folks that are familiar with this and have tuned in before, we relay that cash flow effect to a series of 6 key appraisal metrics. The bars are showing the percentage change on those metrics over the quarter. There's no perfect science to it. You can't sum those bars to get the cash flow effect, but the color code gives you a sense of what's having a positive or negative impact on those forward projected cash flows, which is then the impact on value. So mixed sets of results across the sectors, some trade-off in the metrics. First off, maybe no surprise, occupancy levels here down across the board. Contract market rents still generally heading in the right direction, although for the offices, that market rent movement is pretty minimal, and there's a mix of the results when you get into the geographies, and we'll get into that detail. And those market rents are then being paid back by generally reductions in those projected growth rates in the appraisals. And that's definitely not a one-size-fits-all occurrence. So I wanted to open up that down below to give you a sense of the movements in those growth rates, both 10 and 1 year, and also the levels. So apartments and industrials, the blue and the orange, they're being dialed back from elevated levels, but they're still trending above the 3% average kind of pre the pandemic. Growth rates for the offices, though, on the grey bar, are being continued downgraded, with some of the larger corrections coming through towards the back end of last year. The retails, that's the yellow line there, is the one sector that, having corrected earlier, is now trending back in the right direction. If you focus actually on the right-hand side, which is the year one of those growth rates, you can see how retails and offices have pretty much traded places with one another. Office growth rates in year one down to near zero. That's where the retail sector bottomed out to at the onset of COVID, but has been gradually ticking back up, and it's now back up to 2%. There's clearly a kind of trade-off here between market rents versus growth rates. They're still net positive on the industrial side, but negative when it comes to the apartments, even more so, with no market rent gain and the cutting back of those growth rates when it comes to the offices. The added downward pressure, though, for offices is embedded in this metric here, and that's the year one operating expense ratio, which is picking up a mix of rent concessions and increases in operating expenses. The ratio of projected out operating expense for the next year versus gross revenue for the next year, and how that ratio has changed here over the last 3 months. So, put another way, when it comes to the offices, that cost to revenue carry is increasing, notably so for the offices versus the other sector. Robbie, I was a little surprised maybe not to see that metric spiking out a little bit more for the apartments, given the increase in operating expenses the market is facing at the moment. So maybe your just thoughts on that specific.
Yeah, I think the one thing here is still show apartment stuff, but still show also an increase in expense, right? So the only thing is the
Sure.
magnitude is being overshadowed by the office, right?
Right.
So one of the main reason is basically there's less changes in ratio because apartment are not seeing the decline in revenue compared to the
Right.
office, right?
Yeah.
So I think that's one thing that's impacting in here. And got that as there's the portion of 2024 budget is already incorporated in 4Q, but portion of it might be incorporated as well in 1Q, right? So you might see the lingering effect of the higher expenses going to this coming quarter as well.
Yeah. Well, actually, let's just chart it there. And you can see that actually the offices, when you chart it over time, are the only ones where that kind of operating expense has been ticking up period over period. The other chart here picks up that capital cost ratio, and crucially, you do need to throw that in the mix because the amount of additional capital, certainly when it comes to the office market, that's been now being required for investment into a number of those office assets to ensure they remain, say, competitive in the wider real estate landscape. Here, you're including obviously TIs and leasing commissions and increases. And those are going to be putting further downward pressure on those cash flows. And that capital cost ratio certainly did spike out a little bit in that towards the back end of last year. Okay. Moving away from just the top level details on the sector, let's look to return levels across the major metro markets. So apologies everyone for the massive color and numbers here, just to navigate you around this. We're looking at the major metros ordered west to east. For those folks that are familiar with this, everything that's not covered by those larger 16 are portioned under that other grouping there. Maybe some of the more non-primary markets captured in there. This is the kind of setup that we start to analyze portfolios when it comes to the attribution analysis, so things on a sector by sector basis. In terms of the color coding, and just take you through the detail there, and maybe some top level pointers, and then we'll get to the detail of sectors. But on that top one, everything is color coded north or south of that kind of 3.3 negative operating asset return for the overall ODCE. So you get a sense of what's either accretive or not to that overall ODCE return. You got the same set of numbers there, but for Q3. And then down the bottom, you've got the difference between Q3 and Q4. And obviously the vast majority of that is in red. The vast majority of the market slackened off during the quarter, culminating bottom right-hand side in that near 2% dip in the overall ODCE return for the quarter. Taking that top chart, just row by row, and some of the main observations. First off, on the apartments, pretty broadly based in terms of the kind of the order of magnitude. Most of the markets are in red, lowering the overall ODCE rate of return. For the one below, the industrials, a bit more variable, but maybe a real tempering down to note there of some of what have been the real growth spots in that kind of upswing post-pandemic. We'll get into that. For the offices, it's again more the challenged gateway metros that have been the hardest hit, and that seems to be a real focus in Q4, more so than in Q3 when we saw reds across the board, a bit more of a mix of reds and greens for the offices in the last quarter, with some of those kind of Sunbelt markets holding up relatively well. Retails and other, more often than not, in green, accretive to the overall ODCE return. So let's take things sector by sector. Start with the apartments. Just to navigate you around this table here. So up top, we're showing the last 4 individual quarters. Then we've got the 1 year. And then at the base, you've got the 4-year annualized results. So you get a sense of how things have played out since the onset of the pandemic. Just to complicate things, we've switched up the color coding here. So the reds and the greens now are highlighting the returns of each of these markets, north or south of the respective sector averages, which are listed down there on the right-hand side. And the apartment sector, what's apparent, and we've been referencing it over a number of these webinars, when you look at the Q4, is that power shift that's played out between the Sunbelt and the gateway markets. And some of that, we started to talk about this last quarter, and we're seeing it again, is starting to unwind, but not in its entirety. So thinking about the main metros, you've still got in the red, you've got DC, you've certainly got the same when it comes to San Francisco. So you sense there may be a couple of the markets more heavily influenced by remote working practices. They continue to struggle, whereas the likes of New York in the green, Chicago, Boston, kind of holding out comparatively well. At the same time, you've got certain Sunbelt markets starting to be dialed back from prior elevated levels. Phoenix, certainly a case in point in there, from going from green to a swathe of reds. And also, you could pick that up in that other grouping, previously an outperformer, now dipping below the average for the sector. And that includes quite a number of Sunbelt spots in there. On the Sunbelt side, though, Dallas, Miami, still continuing to perform comparatively well in this kind of contracting period for real estate. So for the apartment sector, less binary, I guess, than it was when it comes to that kind of Sunbelt versus gateway divide. If you then just break the numbers down, so just taking the Q4 and breaking that down, taking the appreciation part of Q4, separating again into those yield versus cash flow components, focus on the left-hand side, you can see that for Q4, most of that reduction, as we've noted on the pricing side, but almost all apartment markets now, it's both negative on the cash flow and the yield side. So that cash flow is starting to trend down in the majority of markets. And off to the right-hand side, I put the kind of breakdown there for Q3 just to compare against. So a couple of things to note there. First, on the pricing side, whereas before that yield adjustment was taking around about 2.5% off values, that's now more in the region of what's that, 3 to 5% off values. And then more pertinently, cash flows, which were back in Q3, more often than not still accretive, providing an element of protection, they've now trended the other way. And they're pretty much all of those are now trending south. So it definitely feels as if we've crossed the watershed moment there in the apartment sector, certainly with regard to fundamentals. Robbie, taking that cash flow effect, I've picked out some downside aspects, looking at the valuation metrics, some reductions in market rents. And that's, if you look at those markets, there are a lot of Sunbelts where supply may start to becoming an issue. I guess you've got the reductions there in those growth rates, and also under that operating expense ratio, picking up some of the increase in operating expense. So, Robbie, do you see this as a momentary setback or maybe start of more of an ongoing trend?
Yeah, I think the interesting part about this chart, Phil, I think that how it's actually split more east and west coast, right? So you look at a lot of the west coast MSAs on the bottom of that, on the bottom of the list, on the left, on the right side, right? So of course the east coast more on the green side. I think part of it is many of the west coast market are seeing the tax slowdown and you get supply issue, right? So that's why you see more negative cash flows on that side. And it's pretty consistent to what we discussed the previous quarter, right? So in the near term, there's definitely pressure on supply issue. Take Phoenix as an example. And this chart is a perfect one because Phoenix have a pretty big negative market rent below there, right? So I think Phoenix is one of the market that basically the vacancy have shoot up, right? So it's more than 10% now in year in 2023. It was less than 6% in 2021, but 8.5% in kind of year end 22, right? So that's part of the issues of the increase on construction in 2022 and 23, right? So, and then now you couple in with higher expenses, with the operating expense ratio being higher as well on that side, right? So I think that's what we've been facing in the near term is a supply issue on some of the market. Overall, though, investors are still bullish on multifamily, basically on the mid and long term, right? So once this new supply get absorbed, it's definitely going to be significant drop off on new construction following this, right? But it is harder to pencil out new construction today, higher material costs, higher labor costs, higher interest rate, right? So it includes regulation, right? So the other thing as well that's helping the multifamily is the home ownership side, or basically single family owner side, right? So with higher mortgage rate, many of existing homeowners basically have the golden handcuff, right? So they have interest rate in the 2% versus market 7. So which means they're staying still. You get less availability of home for sale in the market, also less affordability to basically buy versus rent, right? And less construction as well, with the construction issue on that side as well, right? So that will help give more tailwind to the multifamily sector as well in the mid and long term. Again, once this near-term supply issue being absorbed.
So hopefully just a short-term setback on those cash flow fundamentals. But yeah, thank you for that extra detail there, Robbie. Let's move over to the industrial sector and focus here first off on the most recent quarter, with actually quite a mixed set of results. The main difference I picked up is really between the markets that are tapering off, having been the real powerhouses of the industrial sector in that post-pandemic growth period. And you're citing there those Southern California markets, but also New York, New Jersey, versus the ones that you might say are gradually just establishing themselves or reestablishing themselves: Houston, Chicago, Atlanta, and DC. They're in the green. Within that, we may have a degree of maybe normalization playing out within the sector. If you delve into the appreciation side of things again, break it down into the pricing and the cash flow, and here we're looking at the movement over the 1 year. The first thing I think that's worth noting on this is on that yield effect, that adjustment to that increased cost of capital is pretty broadly based. And actually, it's the blue bars, the cash flow, that play into the varying hierarchy there on the left-hand side. Basically, I think there's a 3 percentage point variance I noted in terms of the yield effect, and the 19 percentage point spread on the cash flow side. The markets that are experiencing the larger valuation setbacks are the ones where the cash flow gains are offering up now pretty muted or limited protection against those rate rises over the course of last year. And for those markets down below, comes down to a combination of some larger cutbacks, those growth rates, which were in a number of those markets, we're thinking of LA, New York, New Jersey, Riverside, pretty elevated levels, that, and also less increase in their actual face market rents now over the course of last year. So I wanted to run a bit of quick analysis on this, just on the cash flow side and the limitations, to get a sense of that at the base of that, and really how much that is down to those markets becoming expensive and our rents maybe kind of starting to reach a bit of a threshold. So what we've plotted here for every dot is one of those CBSA markets here. I've plotted on the horizontal axis the cash flow aspect of appreciation for the last year versus $1 per square foot. So that's the cash flow aspect there, and that is your $1 per square foot on the horizontal. And you pretty much get a linear relationship that runs through those series of markets. The markets that are now seeing the larger cash flow gains, this cluster of blue dots here, are the ones that are operating off the lower rental levels. I've pulled out an illustration there of one of those dots being Atlanta, and you can see, you'd also see in that grouping, we've got Chicago, Houston, Dallas, and they're seeing now a steady series of cash flow gains. Whereas down here across these markets, that kind of rental level gain and cash flow gain is a lot more muted. And that dot there is in the Empire. And actually, you can see that cash flow has just turned negative in the last quarter, including that cluster of dots. You also have LA, you have New York, New Jersey as well. Just to mention, you would get the inverse of this relationship if you run it on a 4-year basis. They're clearly outliers down there, and we should put when we send this out, we'll put the names of the dots. That's Denver, which is one of the markets which has one of the higher vacancy levels. And up there, you have Miami. We talked about this last quarter. It's really starting to set itself apart on the upside. But Robbie, anything you maybe want to add into this in terms of tapering off, in terms of demand drivers that we're seeing, maybe some supply issues coming in with regards to the industrial sector?
Yeah, it's definitely an interesting kind of a contrast between 4-year and the 1-year basis, right? So many of the green market have turned red, right? So you got the LA, Inland Empire, New York market, That was the darling in 21 and 22, right? So that market has become red, right? And IE is a perfect example on this chart in here, right? So the cash flow effect, look at that cash flow effect. It's turned negative this quarter, right? So not necessarily the decline in NOI, but it's definitely lower projection, right? So compared to the previous quarter, right? So this market is seeing significant increase in vacancy, right? So vacancy is now about 4.5% to 5.5%, depending on market, the report you use, right? And US, like we talked about it previously, right? So in 4Q22, it's like less than 2%. Even previously, it's less than 2%. The absorption have declined in 23. Right? So delivery was elevated, right? And the rising costs, lower consumer spending that cost retail to reduce the inventory, which then reduced the occupancy toward the 22, right? And while like a landlord doesn't have the same kind of leasing power it was previously, right? So that's what's being reflected in the cash flow side. Again, many of the investors we talk to and owner we talk to indicate it's more short-term issue, right? With the decline in the construction start, we're going to see kind of significant decline, slowdown in completion as well, starting from 25 on, right? And nationally as well, the vacancy overall is still 4.5% to 5%, so it's still pretty tight. So again, I think that the midterm to long term, industrial still poised to kind of come back, but the near-term supply issue in some market it definitely was a challenge.
Yeah, and I think when we polled it last call, the majority of people said, I think it was either retail, they said, or office or industrials being the stronger performer for that, or the more resilient performer for this coming year. The other thing that obviously we've noted, and maybe Robbie, you want to talk to this chart, we'll be certainly talking to clients on a one-to-one basis around this, because we've seen certainly a relationship play out on the industrial market when it comes to the lease length. So certainly with regard to pricing, do you maybe just want to pick up on the detail that we've sketched out here?
Sure. I think we did start it last quarter, right? So trying to break down the metrics by wall, right? So not every cap rate are the same, right? So that's reasoning people why certain cap rate, right? And again, I think that the way we look at it, we just take the bottom of the number. So if you take kind of the year like 4 something cap rate, that's kind of the in-place cap rate, right? And then you go all the way right underneath the blue bar, that's the year after. So basically, what is the cap rate basically in year 9? And then we know that there can be some roll in the year after in some cases. So we're trying to see what is then stabilized then at 2 year after. So year 10, that's what the number look like, right? So what this trying to show is basically when investor buying certain asset, they might cap rate at 4, but in reality, what they're looking for is basically the bump in the cash flow when the lease roll, right? So I think that's what we're trying to show here. But overall, we can see that basically that the overall quarter to quarter, so the left one is basically previous quarter, the right one is basically this quarter. You can see throughout there's movement in pricing, right? So in our wall type, but we can see like generally there's a little bit more higher on the longer term wall than the shorter term wall, right? But yeah, so definitely that's what we're seeing in here. Generally, longer term wall, people don't want to have too much negative for too long, right? So that's why you start seeing increase in cap rate there.
Sure. Excellent. Thanks, Robbie. I say we'll certainly be analysing portfolios against this chart here when we see them over the course of the next few weeks. Onto the office market then, clearly the most challenged sector. Q4, on the face of it, looking at the reds and greens, those results looked a little lopsided. And the New York and San Francisco was actually in the red below that, kind of minus 6.1%, but actually on closer inspection, it's the usual suspects, the main gateways that are coming down the lower end of the order: Seattle, Chicago, Boston in there, Chicago's there. And actually the ones that have held up better are the Sunbelt spots. They're the ones in the darker shades of green, the likes of Dallas, Houston, Miami, and Atlanta. Markets are typically seeing maybe a greater degree of utilization of office space. And those variances are certainly what we've been seeing playing out now at the bottom there over the course of the last 4 years. If we could just for Q4, again, separate the top from the bottom end of the order, break it down into those yield versus the cash flow effects. Thinking about those blue bars, the cash flows, there's definitely a kind of split between the haves and the have-nots from a cash flow perspective. There's definitely, the haves are definitely in the minority. They're the markets that are seeing a little bit more utilization of office space, where some of those Sunbelt markets where actual market rents are ticking up, growth rates are trending in the right direction, whereas you've got the reverse for the vast majority of markets down the lower end of the order, with reductions in growth rates, some reductions in those face market rents. This is just in the 1 quarter. You'll certainly see that over the year, and then add into the mix that additional capital costs that need to be invested, and that's putting further pressure on the majority of the office markets at the moment. In terms of getting into the detail of the performance levels, more recently, we've taken our interpretation of the office sector one stage further. We've actually then broken the markets down into low, medium, and high risk. We've also separated out the life science and MOB, because in the data set that we're still getting from NCREIF, although that subtype exercise has gone through, we are embedding here the life science and MOB assets in that number. The difference between high, medium, and low on the traditional office is really based on occupancy and lease term, as the legend kind of marks out. And where you've got the shorter leases are those assets in what have been identified as the more challenged markets. So in terms of the weights, around about a third of the office market is in the red, classified as high risk. 40% is in the medium. You could go dark to light orange in that respect. 10% with kind of over 95% occupancy and over 7 years on the WALT is low risk. And then you've got just over 10% life science and MOB. And the kind of 3-year appreciation numbers are correlated across those when you see those stepping on the right-hand side. We look at those 3-year movements and then open that across the major CBSA markets that we've been talking about. So now we're breaking down CBSAs into those respective risk bands where sample sizes permit. It's the high risk ones in red that are unsurprisingly the ones that we have had the larger write-downs. And then just in terms of noting the quantum, over 45% risk North office markets in high risk for DC, San Francisco, almost 50% there for New York over the last three years. In terms of the medium risk, New York and Chicago, almost 40% down for those assets. The overall office is around about the 30% mark. That's the all general office. The all office itself is around about a little less, because that's then propped up by the life science and the MOB. But Robbie, maybe your thoughts on the thread, but maybe more pertinently, looking ahead, are we looking at further corrections down on these numbers in the coming quarters? What's your sense?
It is. I mean, they did take a slight breather in 3Q, right? But it continued the downward trajectory here in 4Q, right? So part of it, what we see is more and more pricing discovery, both on the transaction front as well as leasing front, right? So that's how you see both earlier the negative kind of cash flow and yield effect, right? And again, we're seeing more increase in expenses, higher capital, which means TI for new leasing, right? So there's a lot of stuff being embedded into this, impacting the more negative to it, right? So the one thing to note, if you look at the 3-year basis, like people say, oh, there's no write down. You can look at it's more than close to 30% already, but some of the major market have down the high risk asset is down. Some like New York is close to 50%, right? And then you get the San Francisco, you get the DC, that's more than 40% on high risk assets. So definitely down. But is it enough? That's something that basically on the valuation perspective, that's continued to be challenged as a lot more transaction in the market today as well that's coming in, right? So there's a lot more, we call it green shoot. Part of a green shoot also leasing, and leasing also proving that basically how is the rent compared to appraisal rent, right? So there will be definitely, I would say, continue to be significant headwind basically for the office sector, right? And every single week, maybe every single day, you see the news, there's always negative news on office, right? So there's no break on office right now. And the banks are not willing to lend at this time yet as well. So I think that's what the challenge in the office sector.
Sure. No, thanks, Robbie. And then finally, just one last slide, I believe, on the retail sector. So retail's pull back on value, all from the yield side. This is for the 1 year. Cash flows generally in the ascendancy. Rent growth rates have been ticking up, heading in the right direction. Market rents are also moving in the right direction. So that kind of market to contract rent spread is on the rise again. So hopefully that bodes well for the ongoing performance of the retail sector. The regional malls for the last year, with that increase in footfall, they've certainly seen quite a notable tick up in that cash flow respect in that regard. But that positive Cash flow, with the exception of some property specifics there, the fashion specialty centres are thankfully all moving in the right direction as that kind of sector has started to right size itself. And there's a couple of, I sound checked them last time, but there's a couple of good research pieces, Cole Perry on our website that are definitely worth checking out. But Robbie, maybe your thoughts around the retail sector.
Yeah, I think that the retail sector is in a sense going through a significant correction previously, right? So now they're just seeing the increase basically cash flow, right? So more activity there coming online, a lot of them. So I think that's what's showing the retail relatively boring. The best asset type in terms of cash flow, they're all relatively positive except fashion, right? So compared to other property types, but they're also seeing the impact on the yield effect, right? So that's not applied to just one property sector, applied to all sector with the higher yield to transact.
Okay, so I think we've gone through pretty much all the details that we had to set out in front of people. There's one final polling question there, so maybe Robert, you just want to take that one?
Sure.
And then we can see if there's anything in the Q&A box. And yeah, we have gone on for a fair amount, so anything that's come through, we'll obviously answer and circulate responses on the questions we don't get to.
Sounds good. I can hear like the same poll as previously, right? So what is the total unleveraged property return to be in 1Q 2024? So note it's like a 3.3% negative in 4Q, right? So is it some positive movement or is it -2 to +1? So i.e. appreciation being 0 to -3, or is it similar to last quarter, -4, -2, appreciation -3, -5, or is it significantly more negative, -5? So I'll give people a quick time to fill them in. And let's see what the result is. The answer is the same as last quarter. People choosing same answer as last quarter. So -2 to +1. So appreciation between 0 to 3%. So more than 50% of it. It's almost identical. It's 40% choosing the -4 to -2. It's like a groundhog day here, Phil. So
thanks everyone for those responses. And I think there's just one slide just sums up the main talking points, but I don't think we need to read through this verbatim. So maybe, Robbie, if there's any questions that have come through in the chat box, then pick through a
yeah,
couple
I think
of
that's one kind of asking the question is basically, well, what is the impact of replacement cost, right, to the valuation? So I'll take that, Phil, right? So again, I think the replacement cost basically is right now is being considered, but not necessarily being put into the valuation, right? So that's why a lot of people feeling positive on industrial and multifamily is part of it. Is it going to rebound at some point that replacement costs higher? But it's still tricky part of replacement cost is still land value, right? So what is the land value today as well when there's not a transaction there? And the other thing as well in office, you can talk replacement cost all we want, right? But you're not going to replace an office. So there's no cost of there's no replacement cost in office either, right? But it's being considered in some markets. Typically, they still say more bullish on the mid and long term just because on that replacement cost portion. Next question is basic. That's one question that people ask about like a lot. It's basically how do we look at it? I think yesterday article from Green Street saying that Odyssey fund is still lagging, right? So still basically lagging by 10% plus, right? I think that's kind of like one thing in there, and why real estate kind of appraisals seem to be lagging on that basis. So the way I look at it as well, REITs, public's a bit up and down significantly, right? So it seems like the way that we use it, okay, it might rain, I use my umbrella. Maybe not, take it out, right? So it might rain again, you still get wet regardless, right? But at least in private real estate, the valuation are down on asset by asset. So we're going to look at it basically transaction happening. For sure, with limited transaction, there's a little bit of kind of trying to dig for information, right? But it's definitely more reflective on the asset by asset transaction out there, right? So I can also point to, if you look at the apartment REITs perspective, it might be trading at 6 to 7 cap rate. But look at transaction basis, there's a lot of the deal going on in basically some mid 4, a lot of them are in the low 5 category. That's a lot lower cap rate than the REITs transacting. So partially also because the type of quality of Odyssey fund versus the REITs, right? And the next as well, that basically the REIT may be higher leverage, like Odyssey is like 25% leverage as well. So that's might impact some of the valuation, right? But I look at it, maybe there's some information digging on some of the sector here and there, right? But definitely more reflective on asset by asset basis and valuation more to the actual transaction. Anyhow. There's one question about basically, Phil, on our look at it, what may create the new subtype, right? So when is it coming out? Is our analysis going to change that? So it's life science going to be broken down and SFR and stuff like that.
Sure. And those folks that are linked in with the NCREIF network, there's been quite a number of webinars on that actually in the last week, talking about partly the inclusion criteria on Odyssey with the adoption of the new subtype. So it's currently a live debate that's happening in the background at the moment. You can and go onto the NCREIF website and run queries on them, but the benchmark data sets that they're providing on the Odyssey portfolios, that's still waiting in transition. So we're hopeful that in the next quarter, hopefully not two, we should be in the recipient of those. And so at that point, you will get all the life science MOB categorized up, that we can separate it out. The SFR will fall into what we call the wider residential sector. At the moment, a lot of that is sitting in other. So at the moment, it's still a bit of an eclectic mix, but we're hopeful once their kind of inclusion criteria has been thought through, that'll all be released across the Odyssey funds. So that's what we're, I believe, currently waiting on.
Yeah, I think for interest of time, Phil, I know there's a lot of questions still out there, but we're going to address them during our one-on-one, or we can email it individual.
Okay. Thank you, everybody, for dialing in. If you're still in there or we haven't moved on to your next meeting, we really appreciate everybody's interest in this analysis. So thank you, everyone, for registering. And for clients that we're working with, we're certainly looking forward to having conversations with those over the coming weeks. If anyone is interested in the more detailed comparative analytics we provide, then please obviously get in contact with your Ultra's kind of key representative, or send stuff straight through to myself or Robbie. But yeah, thank you very much. Thanks, Robbie, especially, and everybody that's helped put this together.